A by-election delivers what's been called the worst possible result for the UK government. So will the bond market again get nervous about its borrowing? The Green Party trounced Britain's ruling Labour Party into third place in a crucial by-election on Thursday, a result described by one Labour MP as the worst possible for the party. It reignites speculation about a change of leadership as Prime Minister Keir Starmer comes under pressure to move left. Geoff Yu is senior EMEA market strategist at BNY. Geoff, in British politics this feels seismic, but how has the bond market reacted?
Well, let's just say, in the grand scheme of things, looking at where 10-year gilts closed yesterday versus the market open, 1.5 basis points doesn't really sound like much. And just bearing in mind, we are amidst month-end rebalancing flow, so there's some technical flows going on as well. I guess right now, yields are actually lower as far as fiscal conditions right now. I think around the world, bond markets have actually done well throughout the past month. People are looking at other drivers. Let's see how things develop. But for the time being, it doesn't seem to be really much of an event.
Last week there was a record surplus reported in the UK public finances. Is the gilt market becoming less sensitive to this sort of day-to-day political disruption?
I would very much say so. And looking at our flow data in terms of holdings, in terms of especially domestic buyers, what they look at is real rates, and real rates have been quite attractive for some time. Even taking into account the Bank of England's easing path, which we think will continue, they still see it as quite attractive. And bearing in mind, Governor Bailey is starting to talk up productivity. This is really important for the UK because that actually raises real yields, it helps lower inflation, and that can make gilts more attractive as well.
Rising productivity might be a positive data point, but we have seen in recent weeks a cooling of wage growth in the UK and unemployment rising over 5%. Is that a cause for concern?
So if you look at where unemployment is going, if you look at where wage growth is going, this is showing signs of softness around the world. I think in the grand scheme of things, what's happening is this labour supply challenge that we've had since the pandemic, that is finally starting to wear off. I look at some areas like Central and Eastern Europe, which has seen really phenomenal nominal and real wage growth. That's starting to cool as well, opening up the way for their central bank to begin to cut rates. Of course, there's a lot of debate going on what actually is driving up unemployment, or rather, I would rephrase that and say what's driving the lack of employment growth. Because if you look at where wage growth is, that's sort of, especially in the US, not consistent with much more benign headline growth data. So I think this is really where central banks want to identify some of the challenges. But overall, I do see it as opening up further potential for the Bank of England and other central banks globally to cut rates and ease financial conditions.
The Bank of England is starting to look like an outlier in developed markets in terms of how high rates have remained. Are they perhaps behind the curve?
So I think each country has its own curve right now. Each economy has its own curves in both directions. That's what the Bank of England will do. I will say that perhaps relative to peers, the Bank of England's splits in terms of the hawks and the doves, that is much more apparent. But on the other hand, that actually is very easy to communicate to markets. So I see that as a good thing in terms of Governor Bailey being the swing voter, and he was very clear during his testimony earlier this week. He wanted to say he would want to look for justification for cuts. Now, if we look at where the burden of proof is, this is very interesting language. He said, look for justification to cut, not looking for justification not to cut. So this is asymmetric. It means that he's still a neutral, the swing voter, but not leaning towards an underlying bias towards easing yet. If he goes on the other side of the fence, right, then I think markets will be a bit more aggressive in pricing things in. But for the time being, I think he's not overly concerned about the direction of travel for the UK economy is. Otherwise, his language would be different.
Briefly, Geoff, wage growth has slowed across Europe, as you said. The ECB, of course, isn't expected to go anywhere this year, but could this start to reignite a policy debate there?
Absolutely. I do think that the risk is certainly skewed towards lower ECB rates, perhaps not within the next 6 months. A lot will depend on where inflation is going. We're going to have over the coming days preliminary inflation prints all over Europe, and you're seeing like really wide divergences. For example, if you look at France, CPI is was 0.8% in January. It's barely staying above 1 right now, whereas in Germany it's staying around 2. So these levels are very different. And then for the ECB, who are you setting monetary policy for? So they'll look at the headline figures at the end of it. I will say in the short term, they will also be cognizant to upside risks from any supply side shock from energy prices.
That was Geoff Yu of BNY. Don't forget you can watch more videos on Reuters.com.